Hi, Karen here with John and Bill. This is episode 2 of Thick Sustainable Infrastructure Finance, and we're here to dig into where, why, and how we deploy capital and why urgency matters as we help build the bridge to a sustainable future. Bill, would you get us started by unpacking the term thick sustainable infrastructure finance?
Sure. Thanks, Karen. Infrastructure finance is well understood and currently the subject of a lot of public discussion. 40% of the infrastructure in the United States is owned by local governments and financed in the municipal bond market. And these projects provide energy, water, waste, and other infrastructure systems that are essential to our society. Infrastructure has 3 distinguishing characteristics. First, it's ground zero for environmental sustainability. This is where our economic production, our economic system, comes into contact with the environment. Second, it's deployed over a long period of time, spanning generations. The infrastructure that we put in the ground today, we need to be very thoughtful in how we construct it because it's going to impact people in the future. And third, it's deployed at a scale where individually or collectively, it generates the most meaningful impact on the environmental challenges that we face.
So that's traditional infrastructure, and our twist is thick infrastructure. Thick encompasses projects and systems that have environmentally resilient or restorative attributes. The level of thickness reflects the overall environmental benefits. The thicker, the better. In addition, thick sustainable infrastructure is material, scalable, repeatable, and measurable. It addresses head-on our common global environmental challenges.
So who is thick sustainable infrastructure for? It's for investors that seek to invest in assets that make an environmental difference in real time today and for generations that follow. And it's for investors whose portfolios include fixed income as an asset allocation to provide diversification, income, and a hedge against financial disruption. Currently, bonds are at the end of a 30-year bull run. Coupons and yields are low. But bonds that finance thick sustainable infrastructure are high quality, they're liquid in the event that an investor needs to sell, and they're a valuable asset to own during difficult times in the market. Further, they're essential to our collective sustainable future.
So now let's overview how we find these thick, sustainable infrastructure bonds. We first begin by identifying offerings in the public markets that respond to our criteria. So one of the sleeves we work in is restorative infrastructure. And in that case, as depicted by this slide, our screening process starts by looking at how a bond might interact with these 4 types of natural capital depicted on the left-hand side: energy, potable water, atmosphere, and habitat. If we think the bond passes some initial screens, we then perform deep project or systems research to score the thickness of the offering. We use a science-based proprietary methodology. Now, we score in 2 sleeves again. We score for restoration, which is about the long-term impact of the infrastructure relative to its environment. And we also score for resiliency, which is an equivalent way of saying adaptation or mitigation in the face of the inevitable consequences of climate change, which are upon us in real time now. This rigorous evaluation process leaves us with a set of bonds that we feel must be invested in, the sooner the better. But our vigilance doesn't end there. We continue to monitor these investments over their life cycle and evaluate their environmental performance. We believe this diligence and deep understanding and research constitutes a differentiating advantage to the product offerings we're providing, the thick, sustainable infrastructure products. And that, combined with our relevant experience and expertise, provides investors with something they can't get in many other places in the market.
The investment opportunity is very large. At the recent COP26 conference, leaders in global finance committed $130 trillion just to climate change. And closer to home, CDP, a not-for-profit that tracks sustainable infrastructure projects in the United States, stated that there are 97 local governments that are currently constructing 304 sustainable infrastructure projects that will need $10.6 billion in additional capital. The number of sustainable infrastructure projects and related opportunities is only going to continue to grow.
But unfortunately, time's not on our side. The unintended consequences of human progress and population growth, things like climate change, resource depletion, habitat loss, and others, have only recently been understood at the global scale. Only in my lifetime has this been understood. They pose an existential threat to the ability of current generations to enjoy continued progress and prosperity, much less future generations. Thus, we proceed, but with prudence and tenacity, committed to a better future, convinced that we can find the path there. But we do so with urgency because it won't be easy.
So now we have an understanding of the difference between thick sustainable infrastructure and sustainable infrastructure, and why it's meaningful and why urgency matters. Stay tuned. In subsequent episodes, we'll continue to explore a variety of related topics in more depth, and please tell us what you think. We always learn from our colleagues.